I'm the guest here with what is it? I'm the moderator, and I'm humbled to be among such amazing new fund managers as well that have really made their way in the space. So excited to introduce our panel today. So Carmen Palafox, partner at Mila Capital, short for Made in LA. And we also have Monica Black, who is founder and managing director of Function, based out of Miami. And then Samara Hernandez, who's the founding partner of Chingona Ventures. So thank you guys or ladies for joining us. One thing I realized when we were prepping for the call is we have such broad representation that was not initially by design, but we have the outside of the coast as well, or outside of the San Francisco, New York ecosystem. So nice to have such a broad representation. To kick it off today, I wanted to give just a second for a few seconds for each panelist to introduce themselves and talk a little bit more. So Samara, do you want to kick off and share a little bit more about Chingona Ventures?
Yeah, hi everyone. Excited to be here on the last day of Hispanic Heritage Month with a group full of Latinos and Latinas on the panel, because there's very few of us. I've been tweeting this all week, but less than 0.4% of all GPs are Latinas, and less than 0.5% of all venture capital goes into Latina founders. So quick background, I was born in Mexico. I came to the US when I was 6 years old, so super young. I grew up in an immigrant, low-income, dual language household. So I think it's just a different perspective on, that experience provides me a different perspective on looking at deals. I started off my career at Goldman Sachs after graduating from University of Michigan in engineering, and spent about 10 years there selling, mainly during the last financial crisis. So I worked with the most sophisticated managers, selling them our products, market insights, and portfolio construction. And then I went to Kellogg for my MBA, and then afterwards joined an early stage fund based in Chicago, where I was there for about 5 years, and I saw a gap in the ecosystem. I saw one, going in earlier, especially in ecosystems outside of the Valley and others that have less mature angel networks. Two, an opportunity to go into industries that were often overlooked, but where the end consumer was changing. And three, go with founders that were often not being funded. So that does include Latinos, and it does include Black founders and women founders, but many others. So we don't target just racially or ethnically diverse or gender diverse founders. We look at founders from all walks of life. So I launched Chingona Ventures last year. I've made 13 investments so far. We've soft committed to 2 more this month, so we'll be at 15. We're targeting 30 to 40 companies in the portfolio. We invest super early at the pre-seed, where we invest $100,000 to $250,000. We can lead the rounds, but we don't have to. And yeah, we invest in badass founders, as the Chingona Ventures name states.
Love it. Thank you, Samara. Monica, do you want to tell us a little bit more about Function?
Yeah, absolutely. So I'm Monica. I'm from Miami, Florida. I was born and raised here. My parents came over from Cuba in the 60s. And I just moved back home after being gone for 15 years, a little less than 2 years ago. And I was doing venture in the Bay Area and wanted to continue to do venture investing here in Miami in our growing nascent ecosystem. And so Function is actually an investor syndicate. And my thesis is all about building up the potential LP base here in South Florida. We have so much capital here that comes from Latin America, down from New York, over from Europe, but it's really, really underinvested in the asset class relative to some of these other big markets like the Bay Area and New York. And so instead of being another fund manager right off the bat, what I'm doing is educating individuals and family offices that become members of Function and in how to diligence opportunities, both direct investments into companies as well as in the future into funds, and basically allowing them the agency to choose which investment they want to do and showing them how I do the diligence for each one. And so we launched this year. Great time to launch in the midst of COVID, but we've invested just under $1 million to date across 2 deals One is in Latin America, and the other one's actually in the Bay Area. So I've actually, a lot of people hear Miami and Syndicate and think it's like Miami to Miami, but it's actually Miami capital to opportunities all across the Western Hemisphere.
Well, thank you, Monica, for that, and for that intro. Carmen, can you share a little bit more with the audience about Mila?
Hi, everyone. My name is Carmen Palafox, and I am a pre-seed and seed stage investor. I started my career in the world of finance. I spent 15 years at a fund called DFA, Dimensional Fund Advisors, a very economic and theory-based, with strong ties to the University of Chicago, where Samara is at, and transitioned from public equity investing into venture after going to the executive MBA program at UC Berkeley. At that time, I met my two business partners, and we saw a big opportunity to fund hardware companies in Los Angeles. LA at that time was just really thriving in its ecosystem. It's even stronger today. I am originally from Southern California. San Diego is where I was born and raised, and moved up to LA to go to USC. I saw some Peruvians on the chat. So my mom is from Peru. I spent my youth going to Peru and learning all about the Incas, and so have strong ties to Peru, and my father is Mexican. In addition to just pre-seed and seed stage investing, I'm also on the board of the National Venture Capital Association. I just started my 4-year board term there, and also on the founding board of Latinx VCs, and Samara's on the emerging manager subcommittee with me. So we're very passionate about supporting Latinx and starting funds. Thanks for having me.
Awesome. No, that's great. So on that note, and we'll jump around with questions. I'm sure we can all answer it, but just to spread it around the format, I'll ask some questions, and I'll pick a few of the panelists, and then we'll keep going. Can you talk a little bit more about how you started? If Samara and Carmen can go, and then Monica, I'll follow up with another question after.
Yeah, it started with going into VC or starting my own fund.
If you can share a little bit about what caused you to shift into starting your own fund.
Yeah. Well, so when I first got into venture, which by the way was almost by accident, because I didn't ever expect to go into venture, and it wasn't the cool thing to do back, when I graduated from Kellogg. But I got into it, and when I first got into it, if you would have said you're going to run your own fund in 6 years, I'm like, you're out of your mind. What? And when I was going through venture, there's really 3 paths. So there's first going in, if you are in VC, going to join a VC fund and then working your way up through GP. The second is in VC, but leaving and being an operator. So launching your own startup or working at a portfolio company and doing the startup route. And then the next thing is then starting your own fund. And so I explored all 3 options. I saw all this deal flow, and I saw that it was going outside to the coast. I saw that deals weren't getting funded. And then I had enough time where I saw, okay, if we would have invested in this deal that I brought through and made an investment, it would have been worth this amount. And it's not just one, but it was multiple times. So I'm like, I have the deal flow. I built the relationships. I started a fund where it was, I joined on as a 3rd person on the team. So with that, it's like you're doing everything, right? You're building the infrastructure, the process, the thesis, you're doing LP relations, you're fundraising, you're building a brand. And so I had accidentally also built a brand during that time because I was just super passionate about the inequity that was happening in the ecosystem. And I didn't want it to be, this was 6 years ago, this before any kind of movement or anything like that, even before the Me Too movement. And I had personally experienced a lot of things, which we can go over some over one day over margaritas. But I saw that and I'm like, okay, I see this. I'm going to actually create an angel group. So I went out to create an angel group, and I'm like, I have this deal flow, I have this thesis, I have this check size. And I just so happened to, in the ecosystem, as I'm talking about it with everyone, I met my now LP limited partner, who was like, I'm looking to fund a fund like this because I keep funding the same types of funds and I get the same types of returns. So I said, great. So I built a deck around it. I built a thesis around it. It took longer than I had expected, but then I was able to launch it. And I had a supportive former fund that just knew that that's what I wanted to do. So it was a mix of kind of stumbling upon venture, obviously working my butt off and networking, and that story is a story in itself, but then also seeing opportunity, understanding that I had experience doing this, and then going out to start something. And it was an angel group at the time. And I was in the right place at the right time with my now LP that was like, I'm looking to fund a fund like this. So that's how I got started.
Awesome. Got to put yourself out there, and Samara's been doing it, so that's great. It's Carmen, if you want to share a little bit about the birth of Mila.
Yeah. I mean, I'll share kind of the motivation. When I was at Dimensional, and all of finance, Latinx are underrepresented. So at that time, I started looking for networks of Latino deal makers and joined Alpha, which is an organization in the US that really focuses on Latino leadership. And there I started really understanding a lot about wealth creation. So when I left Dimensional and went to Berkeley, my goal and my mission was to figure out where I could increase representation in areas of finance. So for me, the biggest area of wealth creation is in the earliest stages of investing. There's a lot of power there, but as Samara said, there aren't a lot of us. And that trickles down to funding of folks that look like us. And so for me, that's where I saw the biggest gap and the biggest opportunity. And so that was one of also the drivers of supporting an organization like Latinx VC. Again, I'm just looking for gaps in the market where there's massive opportunity and a ton of talent. In Los Angeles, for example, 46% of the population is Latinx. The UC system in itself, 35% of the entering class is Latinx. So I'm investing towards the future. Like Samara, I didn't think that I was going to break off and start my own fund, but at the same time, I just think there's a reason for it. I wouldn't do it if I didn't think that I were filling a need.
Great. A lot of purpose, talking about why we started. Monica, if you can share why did you pick Miami and outside of the San Francisco, New York ecosystem? If you can kick off that question.
Sure. I mean, Miami for me is very personal. Obviously, I grew up here and my family's here. But I also think it's, uniquely positioned kind of at the intersection between the US and Latin America. If you're a Latin American founder building one of like the many amazing businesses that are being built across Mexico, Colombia, Brazil, you could travel through Miami at least once a year. And if you're from New York, you come down to Miami for sun and warmth and to be amongst fellow New Yorkers. There's almost more New Yorkers than Miamians sometimes. And so it's actually like a really interesting point of intersection for a lot of people in business, and increasingly so in tech. And the reason that I started Function, especially structuring it as a syndicate instead of trying to initially go out and be an emerging fund manager, was after kind of assessing the market and realizing that there was already an entrenched angel investing group that's been super successful and comes in at the seed stage and really helped activate smaller amounts of capital into Florida companies. There were basically 4 or 5 new funds, all first-time funds with first-time fund managers. And then there's SoftBank's Latin America Fund, right? Like at the complete opposite end of the spectrum. And that's like a very high level view of the Miami funding ecosystem. And there was a gap in the middle. And I felt that there's inherently also a lot of skepticism amongst the private wealth community here around a new fund manager, a new face, regardless of how good your pedigree looks on paper. And so I thought creating an opportunity for them to start learning more about the asset class directly was a really good entry point. It would upskill them and it would help build my track record at the same time so that in 3 years, I could join Carmen and Samara in launching a fund as well. And that's my end goal in a few years once I've built up a track record with what will hopefully be my future anchor LPs here.
Beautiful. Carmen or Samara, do you want to share a little bit about your focus? Why do you focus in your respective regions, Chicago and LA?
Yeah, so I can start. I actually don't focus in Chicago or sole focus. And I actually have done investments in the Valley. So it's an interesting thing because when you're in the Midwest, people assume that you only invest in the Midwest. And the reason why I don't only invest in Chicago or in the Midwest is that I saw companies that were built here that were able to get some early money, get to a certain point where I'll call it a Series A or a big Series B, where they focus on what traditional investors in the Midwest want to see, which is actually really good, which is capital efficiency, good unit economics, don't grow at all costs, decent valuations, which now I think has become a little bit more sexy. But then you get to the point where you're at the Series B, and then all of a sudden you go out to the coast where you need capital because there's not a lot of funds here that do Series B or growth, and they had a hard time getting capital because those metrics were very different. They're like, why haven't you grown at all costs? Why isn't your valuations higher? Why haven't you raised more money? So I said, okay, I'm going to do 2 things. One is I'm going to go in earlier, even before like the seed investors here go. And that means that going earlier and with the founders I back, I don't only invest in women and minorities, but many times, I would say about 70 or 80% of my portfolio is minority. Even in San Francisco, these are not obvious investments. And that one example of that is Zero Shop, who now has raised close to 5 million. It's a Black woman founder that struggled to raise money in San Francisco, and she worked at a venture fund. I was her like 250th meeting, and when she finally got to me, she had only raised $500,000. And so I invested in, catalyzed around or helped her grow to the next point, and then she raised a much bigger round. So I do 2 things. One, I invest all over, or 2 is that I'll invest in the Midwest. But especially if I lead the deal, I will make sure that earlier on that they have capital in other areas so that they can find downstream capital later and they can understand the KPIs or kind of the language or the story you need to tell for investors later on, if they choose to. But if not, one of my companies has been profitable for the last 4 months. So they don't need to, but they're at a point where they're getting inbound and can raise larger rounds. So when we talk about ecosystems, this is why I invest all over the United States.
Great.
Can I add on to that, actually?
Oh, go ahead, Monica. Yeah.
I think Samara made a great point no matter what you do, like the majority of capital is in the Bay Area, right? Like we're not going to change that. That's going to take a long time to change. And one of the things that I found, and for different reasons, I think a lot of the investors in the Bay Area are sometimes skeptical of founders from outside of the market. In Miami, we have a bad reputation, thanks to like movies, basically, for being all like fake and drugs and parties and stuff like that. And some of that might be self-imposed, but a lot of it is also just the media. And so I have literally heard founders say that founders from here say that they've gone to the Bay Area and gotten pushback being like, I don't know if I can trust you, if I can trust your numbers, and I don't know anybody that can validate you. So for me, one of the value props of being an investor in Miami and investing in the Bay Area or in other markets, but also the Bay Area, is to co-invest with funds from the Bay Area and start building up that reputation with them. And that has trickle down effects for the founders ultimately here in Miami. Even if I'm not directly putting capital into Miami startups right away, it's beneficial for them to know investors that they trust and are starting to build a relationship with. And I know that some of my fellow fund managers in Miami are doing exactly the same thing for exactly the same reasons.
Love it. Like bridging the ecosystem. Carmen, do you want to jump in? Talk
Sure.
about LA?
I think that, yeah, there are several initiatives in California to kind of spread out the concentration of that capital. Governor Newsom has an initiative called Rise of the Regions. So that's all about like the different regions within California. The UC ecosystem is very strong, but there are certain UC schools that aren't in kind of the areas that are most easily accessible or where VCs live. So for example, UC Merced, which is in the Central Valley, that's an exciting area because it's a food tech hub. UC Riverside is also an exciting area because they do a lot in deep tech. UC Irvine does a lot in med tech. So with our portfolio, I think over 50% is based in Los Angeles, but like the others, I don't necessarily just focus on a region per se. It's all about the fact that we're out there, we're hustling, we're involved with different networks, and our community is spread across the U.S.
Awesome. In this time with in COVID, where we're remaining more virtual, and like you said, it's maybe a little bit easier to assess or standard to assess deals outside your region. How are you all cultivating deal flow in ways that one are beneficial for you, but also highlighting more underrepresented founders? And whoever wants to jump in.
Yeah, so I think COVID, the fact that we're all remote and the fact that we're all doing Zoom or other video meetings has allowed for a lot of democratization of capital investing, both from a fund and manager perspective as well as from a founder perspective. So I've seen founders in the Midwest who would have never gone, I think, a meeting with some of the East Coast and West Coast VCs be able to get term sheets and be able to get those big names as leads. And I think this is something that's super important because not only for all founders, but for especially underrepresented founders who may not have those networks, that is huge. So it also causes some funds that are just focused on the region to some pause and to say, should we be changing our strategy? Because just being geographically focused is not a differentiator anymore. So I hope that continues after we all go back to going to offices and traveling, but it's allowed for that. So I'm very happy to see that. But there's still obviously some challenges around that. And I think, the second part is that when you go to events and when you meet people, like I would go to LA, San Francisco, New York every 2 weeks, right? And I would see, Monica or Carmen at an event, and you just don't think to catch up because you're like, okay, we're going to see each other at some point. And so it's being a little bit more intentional about the relationship building, which is super important in venture capital, of like, okay, I'm not necessarily going to see you at this event, but let me be more intentional about sending deal flow or just catching up or just, seeing how you're doing. So I think that's kind of the soft skills or the soft side that we might not be important to some, but it's actually a big important piece of this brand building of this, for me, especially connections for the Midwest to the coast, and for you as aspiring VCs to build that so that you can leverage your network for deal flow as well as for fundraising.
Yeah, I totally. Oh, go ahead, Carmen.
I would say I'm seeing more networking events online, as Samara said, just more shop talk amongst investors, and that is incredibly fun. Hosted one here in LA with my colleague from Muse Capital, and we got all of the top LA female funders together across different stages to just nurture that relationship and talk about what we're excited about, like the top 3 sectors we're excited about. And I think those conversations are important. I think there's room for improvement in terms of kind of swapping deals, but there's a lot going on in that space. And I would say also demo days have gone online. That transition has been great because they're recorded, they're shorter because folks know that attention spans are shorter when you're on video all the time. And so I think that's been good because you can quickly see startups from across the nation and what they're doing.
Yeah, and I would just add 2 things. One is that I'm seeing a lot more people in multiple Slack groups. And so a lot of affinity Slack channels are much more active during this period of time, which has been great for me to meet new founders or even potential founders. So Tequeria, I think, is an incredibly active Slack channel, probably the most active affinity group that I'm a part of, and has been a great resource for me in meeting some of these individuals. And the second thing I would say to Samara's point about like startups outside the Bay Area getting meetings with Bay Area investors when they normally wouldn't have, the same goes for the investor. So like, it doesn't matter to a founder who's raising a round as much whether or not you can meet them for coffee in South Park or Soma, or if I'm sitting here in my home in Miami. Like if the value prop is convincing enough, they'll respond sometimes to my cold email. So the second investment we did, I read about the company because they were hiring. I thought it was really interesting, and I reached out to the founder cold, and he responded and happened to be raising a round, and we were able to participate with the second biggest check after an enterprise focused fund in New York. And so I don't know that would have happened in the time of, I guess, in times pre-COVID or post-COVID. So that's actually been something that I've seen a benefit of from this period of time.
Absolutely. Getting more access across all realms. You all touched on building reputation. We understand the importance of building reputation as emerging fund managers, but for those on the line that are interested in breaking into VC, is reputation, like, can you talk a little bit more about how you all built your reputation and how they can build theirs as they try to break in? Carmen, you want to start us off?
Sure. I think, coming into this industry, I definitely spoke to a lot of venture capitalists that had been in the industry for a long time. And some of the things that struck me, and I think were consistent in a lot of advice, one was just really think about the value you're adding to the ecosystem and to the founders. Each founder has different needs. Some may have a lot of influence, and so their needs might be just a little different. Maybe they just need someone to talk to when they're having a bad day or whatnot. Maybe they need help on developing their organizational strategy or go-to-market. I think it's different by each founder, especially at the pre-seed and seed stage. Maybe they just need an introduction. I mean, we have an active Slack channel for all our CEOs. And once a week, someone will pop in like, hey, can you provide an introduction to so-and-so? So the needs are different across founders. I was also told to just be very flexible. And I think that has served me well. I think, it's a lot of what we do is based on timing. For a company, the stars have to align a lot, and there's tailwinds and headwinds. So knowing when the time is right is important.
Yeah, and around brand, it's interesting because I think I accidentally built one, not knowing it, and it's
I mean,
hard because
Chingona, right? That's it.
being Chingona, yeah. Um, no, I mean, it's interesting because I came into venture literally just like, oh my gosh, I'm so excited. I'm just going to put my head down and just work really hard and get startups. And I had been in sales for such a long time and I didn't realize how much sales is important in this ecosystem. And it's actually a differentiator in many ways. So I never chose to actively speak on panels or to write articles or to any of this. And I didn't even know how much this happened in VC, because at Goldman Sachs, like you literally barely have to, you barely put like your title or anything else. Like everything has to go through compliance. So I was not used to using Twitter or Instagram or anything, like self-promoting anything. And so the first gig I got was because a GP at my last fund, he wouldn't sit on panels if it was only white men. And he was the first of its kind. This was like years and years ago. And so they couldn't find a woman. They're like, we don't know any women. And he's like, well, one just started a week ago at my fund. So here you go. And I go, I don't even know anything. Like, I just started. It's like, just get on there. You're going on there with me. I'm like, okay. So I started speaking, and I, when they say, people always ask me like, what's your superpower? That's a common question you get, especially as you're fundraising. And one of my founders today, she's like, I mentioned that it's your authenticity, and I'm just like, and not to like humble brag or whatever, but like I on myself, but I can't lie. And I'm very like direct to the point where sometimes people like, it's off-putting for some, but I just tell it how it is. And I'm just like, this ecosystem, it looks like this today. We have to be super honest about it. I had personally experienced some things. My founders, I have personally experienced some things, and I just said it the way I thought and what I saw in the ecosystem. And I backed it up by facts. So a lot of it early on was diversity and inclusion focused because of what I was super passionate about and speaking up for these founders. Before it was cool. And now, I'm very fortunate that a lot of investors and others are focused on it and want to invest in that. But at the time it was controversial. And I actually wrote an article titled "Why Your Boss Is Still a White Guy" back in 2016, right after the last election. And it just like, there was so many people just anti that, and there were so many people for that, and it was very opposing, right? I write less of those now, but I think what it did is just it created this brand, and that led to me being introduced to my LP. That led to founders reaching out with the name Chingona. I naturally get a lot of Chingonas reaching out on my website and asking for it and Googling the name. So I'm very fortunate for that. But as I think about any aspiring VCs, building your brand around something that you're super passionate about, that you're authentically really interested in, and start writing about it, start blogging about it, start tweeting about it. And, and do the work before you actually do it. So creating investment memos on companies that you are interested in. And as you have a conversation with an investor, talking to them about it. And you can intelligently talk to them about why you would invest if you were able to invest. And if you can, great. So that's how I think about brand building. It can happen by accident, but I think as long as you're truly authentic and interested, it will naturally occur. And you just have to have a voice and a platform to share your views.
Awesome. Monica?
Yeah, I agree with all of that. The other thing I would say is sometimes it might feel like I don't have anything to add when you're, young, maybe don't have a ton of career experience. I think one of the most valuable things you can do at that point is try to be a dot connector. Founders are sometimes like really heads down building their product. They don't take a step back and maybe see a lot of the initiatives that are going out there, things that they could apply to, things that might benefit them, right? So, but if you're kind of staying on top of that, right, because you're interested in the industry, you're trying to learn, you're on Twitter, you're following newsletters, you're following blogs, like maybe you saw the initiative that Alex Marshall and Mark Monroe launched at First Round Capital, that pairs founders with the first potential customers that they could talk to. And a founder didn't see that, right? Because they're heads down and you've met them. You could literally be that dot connector that tells them, hey, you should think about this and apply to this. And that could end up having a ton of value, not just for that founder, but then you could start building relationships with the team at First Round, and then just keep doing that over and over again, and your networks and your relationships multiply. And that could be a way that you build your brand and reputation in VC.
Awesome. We have a question that came in for Carmen. Mila focuses on hardware. How much do you see this segment growing? And if anyone wants to, it does also look at hardware startups, feel free to chime in. But Carmen, I'll take it off to you.
It's incredibly interesting. I think, for hardware to be successful, an investor really has to understand what the motivation is around the hardware. Like, why are you doing it? Does it give you a key advantage, a key moat? Developing hardware, I think, has, for founders, gotten easier relative to where it was because of advances in 3D printing, for example. So we've had several companies in our portfolio get into pilots with 3D printed devices, which is incredible. And so that device then gives them access to collect data using algorithms and whatnot, and gives them an advantage over another solution out in the market. So for me, it's really, I just, as a hardware investor and having had that experience, really look for what is the value proposition and how does that compare to a software only solution? And is that gap big enough to where it will be durable? Because with hardware, it does take an added amount of time to get to a place where you can actually scale. So I think those are some of the things that I think about. I think hardware is exciting in certain sectors like climate tech, which I'm very passionate about, because there's a lot of non-dilutive funding in those areas. It's a big issue and a huge opportunity, and I think there'll be more non-dilutive capital for founders that focus on critical problems.
I'll say, what's the spin we usually hear? I'm a hardware-enabled software company.
Well, I think, you know what? I think
that can be
I think
true.
There's investors that have come in and said, I will. They enable hardware companies to look more like software. So they'll buy the assets of a hardware company and then just create a rev share or something that allows the hardware company to be more competitive.
Absolutely. Go ahead, Monica or Samara. We had another question come in on sharing about fund economics, target returns. How do you measure success of your portfolio? I'm sure. However you want to kick that off.
So just quick comment on Carmen. She said we look at software that you can touch, and I always remember that. I was like, oh, that's really interesting. And she's so differentiated that like any hardware deal, boom, goes to them. So like that's when we talk about differentiation, that's her, But in terms of the question, so first and foremost, I will not be a VC, continue to be a VC if I don't get outsized returns from my LP. Now, the challenge with that is that in this space, it takes 5 to 10 years to actually see a return. So we call it patient capital. You have to invest as an LP, and then in fund one. So the fund one is, call it like a pre-seed or a seed, where many times it's the team in the dream. Sometimes you have a track record, sometimes you don't. Sometimes you have a first close, sometimes you don't. So it's a lot about the vision. And so that's what I raised my fund one. And I'm not new to investing. I had done investing at another venture fund, but had a different thesis and made different investments. So with fund one to fund two, the typically what happens is that you get to fund one to prove out two things. One is that, actually for me, it's two things. It's prove that I can get good deal flow and that I can be a value added to founders. That's the two. And then obviously follow my thesis of my check size, my industries, the founders, and then be able to see how do I track if they're successful so far. I look at revenue growth, customer growth, product launches if they're super early. I look to see if in follow-on rounds, have they raised more money with a higher valuation or a higher valuation cap. That's what some investors look at, who your co-investors are or who are downstream capital investors. So you'll see all of that. And then we call it TVPI, which is basically a markup in your portfolio, a price markup. So if a company goes from a $5 million post-money valuation to a $10 million post-money valuation, that's like a 2x. And we have to take off some for fees or whatever. But basically you get the concept. It's a price markup. And then from fund 2 to fund 3, that's a different story, because typically at fund 3, most fund cycles or fund periods are 10 years, but the investing period is 3 to 5 years, sometimes shorter. And the time to go back out to market is usually about 18 months to 3 years. So by fund 3, you'll have some sort of returns, and those, not all returns, but the goal is to get over a 3x net return to your LPs. There's a lot of distribution around that in the venture capital space. But with every single deal, that's why you target, some will say 10x, some will say 100x. You target these kind of big returns. So I kind of said a lot, but in fund 1 in particular, I'm targeting this. And I think it's important to say, because a lot of people think I'm an impact fund, and I wouldn't say I'm an impact fund because I'm a woman or because a lot of my founders are diverse. I'm targeting outsized returns, but there's a lot of impact in what I do. And some of my businesses do have double bottom lines they're getting outsized returns and they're helping out the world in some way or making it better. But we're first and foremost financial returns heavy, and we look at every deal based on that.
Great, thank you for that. Monica, do you want to jump in?
Sure, I'll jump in quickly. So we're a syndicate, so it's a little bit different, but basically I charge my investors half the fees of what a fund typically charges and half the carry per deal. So typically most funds will charge a 2% annual fee, and then they get 20% carry on the proceeds of the fund. I charge 1% annual fee and 10% carry. And that's because there's a little bit more risk for my investors, right? Like when you're a fund, you could build out a whole portfolio and play that power law game that Samara was referring to, or some of your investments may go to 0, but if some of your investments are 10 or 100x, it makes up for that. In my case, my investors are kind of constructing their own portfolios and they're smaller. So it's a little bit more concentrated, a little bit more risk. I basically charge the fees that are required to cover the legal and accounting expenses of launching each one of these investments as its own special purpose vehicle. And happy to chat offline about that. It's been a fun discovery process for me. One of the things that I've done that's different than your standard template SPV documents is that I've actually structured it so that the investors can choose when they want to exit the investment individually, as long as there's a third-party option to buy the stock. So an example of this being a company, we invest at the Series A, a fund comes in to lead the Series C, for example, and part of that is they want to buy secondary shares from existing shareholders. Let's say I've done $1 million deal with 5 investors. 2 of my investors say, hey, I'm going to get 3x on this in 3 years, I'm taking it. And the other 3 say, no, I want to let it ride. I've structured it so that they can each choose that path on their own, which is a little bit different. I haven't really heard of anybody doing that before, but it's something that people have really resonated with, having a little bit more control over what that looks like. And so obviously we're in year 1. I have no idea how it's going to pan out, but that is a slight nuance.
Love it.
I would add that, this asset class is incredibly high risk and high reward. When we're investing, we're all, I think, pre-seed, seed stage investors. we're often investing in companies that are under a $10 million valuation, $3 million valuation. If we're lucky, they're like under that. And a lot of venture-backed startups, in fact, are over $4 billion, when they exit, like the outliers. And so, you're absolutely, in some cases, thinking a lot about what does it take to get there and how are you constructing your portfolio. When we're starting a fund, we're thinking about, we have this pool of capital, how many companies are we going to invest in? It could be a minimum of 20 companies up to 50. And what is the breakdown going to look like what's the valuation of each company on your exit, and thinking through how do you get to that at least 3x return, so that your LPs, your investors, get the upside of taking on all the risk of this particular asset class. So the upside is huge. We try to hit the minimum of that at least 3x, but hopefully a lot more.
That's great. No, thank you. You all gave a clearer view of what makes an attractive investment. And then also Monica talking about some of the innovation that's happening in the space. That's a whole nother topic as well. And also touching on, for those listening that are thinking about brand building, you noticed Samara talked about Carmen, and her focus on hardware, and deals just flow to her. So the benefits of focusing. Do any of you want to talk more about that should you focus earlier on in your career? Why or why not? Whoever wants to kick it off. Carmen,
I think investors either have a thesis that they're investing off of, or a theme. So, if you have a PhD in whatever, you're likely going to have deep domain expertise, a deep network in that area, and you'll probably do well investing in that. I think for me, I'm more of a generalist, because I think that you don't know. I don't know when a company could take off. There's so many dynamics at play, regulatory issues, different headwinds that go in favor of a company. So on the regulatory side, for example, in California, now all cars have to be emission-free by 2035. What does that do for startups in that space? It's huge, so I think there's different dynamics at play in that area, and that helps me develop kind of my thesis and my point of view on where I think the opportunities are. So I definitely leave a bucket open for other, because I don't know what founders are doing in terms of solutions. I'm very thesis driven. I believe that diverse teams outperform non-diverse teams, because when you have a group that's gender diverse or ethnic diverse, that you're going to be able to develop a product that's relatable to more people. So again, just in summary, it's like either you're investing off a thesis, or you're investing off of a theme, where it could be deep tech, or it could be consumer, or something like that.
Go ahead, Monica.
Yeah, I think it's earlier in your career, it might be tough to know like what your thing is. Because like, especially if you're like, I know some people in the chat mentioned like they're still in college. So I see nothing wrong with like going and cutting your teeth, if you can, at like as an associate at a larger VC firm, or at a startup even, and iterating a bit until you find the thing that's your thing. And that can change over time. My thing used to be education technology. Now I focus more broadly on enterprise software and fintech. And that's an entirely different conversation. But I started as like a generalist M&A banker and then a generalist private equity investor. And so these things ebb and flow over time. I would say iterate on it a bit, find what you're passionate about and find what you think you're good at. Like, I'm not good at consumer. I'm not like up on the trends or anything. So I don't focus on consumer. I much prefer to like crunch a bunch of enterprise software financial numbers. And that's part of what's led me to gravitate that way.
I was gonna say no cannabis and pea protein for you. No, the new alternatives to meat and whatnot. Being on the edge. If I were to kick off another question, Samara, I think you touched on this before, but I don't know if you want to elaborate on serving investors while and serving founders at the same time. A lot of, like how do you each do that? And I know for those, watching, a lot of VCs are usually, early stage VCs end up being small shops. So, you're doing a lot. How are you positively serving your LP LPs while adding value to founders?
Yeah, I mean, look, VCs have to raise themselves, right? And so you raise from LPs, and that could be individuals or institutions or corporate VCs. And then you also invest in founders. So it's a fine balance of both, because you're always fundraising. I'm literally right now pre-marketing. I can't say I'm fundraising, pre-marketing, but also investing at the same time. And I'm a sole GP, sole full-time general partner, and then I have 2 interns that help me. So it's a lot. But what I learned early on is it really is a lot about sales. You're selling to teams to give them a term sheet, to join the board, to invest many times, and you're selling your fund to potential LPs. So earlier on, you're always fundraising, but for me, it was like at my last fund, the second day I started, they were like, okay, now we're going to target Fund 2 investors. And I learned that so like day 2. And so when I did my Fund 1 close, I immediately started talking to Fund 2 investors, which I'm doing now. So managing both is tough, but it's just like a founder, regular LP updates. I'd send quarterly updates, and then I send potential LP updates on what's going on in my fund. Many want to be co-investors with me, so I send them deals to co-invest. Many of them want to mentor and have advice from my founders. I'm cautious about the mentoring part, because especially minorities are over-mentored and under invested. So I'm like, can you write a check, or can you get them their first customer contract, is really like what would help my companies. And then it's more of like, for me, joint values and missions with my investors. And for my next fund, can they make other introductions to LPs? Can they get a group of other fund managers that they're investing in? Can we work together on similar struggles that we have? Can you provide downstream capital for my founders that I invest in and with? And those are some of the things. But yeah, we fundraise too, so it's very similar to what founders do. So if you're a founder looking to start your own fund, somebody asked that question, I think it's great. You're going to do a lot of similar things, but at the same time, you're going to be seeing like 2,000 deals per year, which is what I see. So you're not going to get deep into one company. You're going to see a ton of deals, especially if you're a generalist. And running a fund, it's not just the fund investing, there's fund management that goes with it. So like the non-sexy stuff. So the back office, the audits, the financials, the stuff that sucks, you do as well. So you're a fund manager as opposed to like building a company.
I love that. You catch that the directness from Samara. She's like, it's just the stuff that sucks. You just got to do it to run your fund. I know we're coming up on time shortly, so to close, I want to go around. I know probably we could keep going, but if all of you can share, since we have a lot of prospective fund managers with advice, just top 2 things you would recommend as they try to make their way into venture. And a lot of people, this is their breaking into venture for the first time, not necessarily starting funds. So Carmen, you want to kick it off, and then Monica, and then Samara close?
Yeah, I would say stay in touch with All Raise and Latinx VC. I mean, both organizations have done a tremendous job at putting out rich content like this. where, you know, you hear from investors what their journey has been, and it's really authentic and genuine. And so stay in touch, sign up to our newsletters, and learn from our mistakes.
I would echo that. I guess in an attempt to add something different, I would say test yourself a lot. Even if you're not in an investing role now, I forget if it was Carmen or Samara who said, like, write your own investment memos, and then follow those companies and see if you were right. It could just be as simple as like seeing an announcement of a funding round and being like, would I have done that or would I have not? And then like write it down and track that over time. Some of the best investors say that they do this constant sort of like feedback journaling loop. And that's a way for you to start testing, because you don't, the interesting thing about ventures, like you don't know if you're right for 5 to 10 years, right? And so this is an interesting way for you to do that, even if you're not investing, and you can start honing your expertise.
Awesome. Samara?
Yeah, what I was going to touch on is doing the work before you actually do it. It sounds sexy to be a venture capitalist, especially when you hear all this stuff on the news, but actually either one, making investments, and if you can't, creating a virtual portfolio where you make investments and you write an investment memo. As a analyst or associate, you're going to be doing a ton of those multiple times a week. And so writing an investment memo on what that would look like, why you have an investment in the company. And then there's a lot of templates online. And then if you can, actually reaching out to the company, and it might be hard to get a meeting with the CEO, but if you can bring value to them, like helping them sign up their first customer, or saying, I'm going to, you know, do your website for free, or whatever background you have. Hopefully not for free work, but I did free work when I was, I'm like, just give me experience. So anything you can provide, because as an investor, you're looking at investments, you'll write investment memos, you'll reach out to founders, you'll try to get them to take your money, you're going to add value in whatever way you can. And then also having a thought on some industry, or having a thesis, writing it down and sharing it. And this is a way that you can say, when you reach out to VCs, say, this is what I've done. These are the investments that I would have made, blah, blah, blah. And people are like, you're already doing it. Great. Right. And so I think just doing the job before you do it is the best piece of advice I can give.
That's that's right on. I also wanted to share for those interested, we have a program at Rebel One. I'll drop the link, that we do a VC intensive, and we do exactly that. We do memos, we invest, and we're also giving scholarships to underrepresented folks that apply. So definitely stay tuned on that. So I just dropped that link in the chat. But to our panelists, Carmen, Monica, Samara, thank you very much for joining us today and sharing your expertise and insight. Want to see more Latinas in venture kicking it, but thank you for helping All Raise close an amazing Hispanic Heritage Month. So thank you.
Yes, thank you all again. It was such a pleasure. We will have this recorded and posted on our website tomorrow. There is a feedback survey sent out. Please respond to the feedback survey. Let us know what you liked, what you didn't like, and what you would like to see in the future. So thank you again, everyone. It was such a pleasure. And we look forward to future events, and what a way to close out. Very blessed to be in this room today.
Thank you.
See you.
Thank you, Marianne, for organizing.